So the first one of mine this week is Crowdstrike. It's not a stock I own. I did own it for a bit. I don't think Steve's ever owned it, but it's a stock that we've both admired for quite a while. But just that valuation, it has always seemed just a lot top heavy and very difficult for us to get our heads around. But yes, a company that we both like quite a bit. And this was obviously their fourth quarter, 2025, because that's just how that works for them. And obviously full year 25, just to make things ultra confusing. And revenue came in at 1.1 billion on the quarter. That was up 25%. Net income of minus $92 million. That was about a minus 9% margin. About 346 million in operating cash flow. That was flat, but a 33% margin, so not too bad. 240 million in free cash flow. That was about 15%, sorry, quarter over quarter, and a margin of about 23%. In terms of full year 2025 earnings, revenue came in at 4 billion. That was up 29%, so very strong on the year. Net income of negative $17 million. That's a margin of essentially zero. Operating cash flow 1.4 billion, up 18%. Free cash flow 1.1 billion, up 14%. So rounding up the financials, it was pretty decent, really. Of the business metrics that they reported, annual recurring revenue 4.24 billion. That's up about 23% year over year. Remaining performance obligations, so RPO, that was 6 billion, up 40% year over year. So good. 112% net retention rate, which is really a decent statistic, but it's come down a long way since they IPO'd. When they IPO'd, it was in the sort of late 135, somewhere around that 138. And it's been trickling down. And this is another month where it's trickled down, another quarter, where it's trickled down again. About 97%, just over that gross retention rate. And if you do the rule of 40, which is one of the ways that you look at these kind of stocks, they get 56. So pretty good, really. In terms of the guide, they said revenue of about 1.1 billion, which would be flat quarter on to quarter, Steve, which would be interesting. They report guide, for non-GAAP EBIT, so you can do what you like with that. $180 million, non-GAAP net income of $168 million. And on the full year, they said that revenue would be about 4.8 billion. That was up about 22%. Non-GAAP EBIT of about $985 million, and non-GAAP net income of about $883 million. And they reckon the long-term free cash flow margins for the company will be between 34 and 38%. In terms of highlights, I said there was quite a few successes. They exceeded their expectations. They demonstrated the resilience. They said total contract value for the first time ever has gone over $6 billion. They said that they have now an improved outlook over the previous quarters. They expect net new ARR to re-accelerate, so that's annual recurring revenue. I think margins at EBIT level and free cash flow level will expand by the second half of 2026, or the second half of 2025 as we experience it. There's a path to 10 billion in annual recurring revenue. They think they'll get there by about full year 31. So there was a lot of talk on there, like aimed at comeback narrative kind of stuff. They said that the customer satisfaction has gotten much higher. That this Falcon Flex product that they've launched has had really strong adoption, and they're really just highlighting the fact that they're continuing to innovate within this space and with their own platforms. They were the first cybersecurity ISV to reach $1 billion on the AWS marketplace in deal value. So that was quite important. And they were talking about their AI advantage, which is called Charlotte, which has a rich data set, they said, for AI-powered threat protection. And it's also driving efficiency as well at the operation. In terms of projections, I said the margins are going to rebound in the second half of 26. If you remember, they had quite a major outage, and being a very, very popular cybersecurity firm, they pretty much took the world out for a short piece of time. And to recompense the customers, they've been essentially giving away parts of the contract for free or fixing things for free, and this has obviously hurt the margins over this short period. As I said earlier, free cash flow margin target of 34 to 38%. I think they'll get there by full year 29. Full year 26, I think the free cash flow margin will get up to about 27. And then 30% in full year 27. So you can see that margin there. They think it's going to improve by about, around about 3% ish a year, 2 to 3% a year from this point forwards. So Falcon Flex, they said it's accelerated module adoption and platform consolidation. Essentially, it's just kind of like, if you imagine modular blocks to cybersecurity, rather than having to buy the package as a whole, they're letting you buy the bits and pieces that you want. Kind of like how Sky tries to sell you TV, Steve, but also you get some of the crap you don't want with it. They're saying their CCPs, which is sort of customer commitment packages, is also driving adoption, and they're seen as easy to renew, and the churn from them is minimal. The segment as a whole, they said cloud security, cloud identity, next gen, SIEM is all showing significant growth. Exposure management is a new segment that they think is rapidly growing, that they've got modules that work in that sector. And they said that they didn't give names, but they said they've made large deals across almost all sectors. But they said big customers came from financial services, from the healthcare industry, and from airlines. So it looked like a pretty decent quarter for me, Steve, chugging along. Obviously, if you didn't know about the outage, I suppose you would look at these, numbers and think, well, so what? This is a company that's, obviously not doing that well. It's pretty much ran for nothing. It's got no margin. It's got this, that, and the other. But when, in context, you can see that it's obviously he's doing, or he's going to do a little bit better than that. It's still an $80 billion company at this point, Steve. And that is after being down nearly 17% this week, off the back of earnings and just the general malaise around the sort of stock market and tech sector at the moment. I know the answer, Steve, but I'll ask you anyway. Is it something you're on the list to buy?
It's got a lot of the features of things that are on my list to buy, or the features that I'm increasingly coming to appreciate as I develop and understand more things as an investor. In a second, I'll get you to just repeat the headline revenue figure for me, Steve. I know you said for the full year that ARR, or annual recurring revenue, was 4.2 billion, I think. What was headline again?
So 1.1 billion on the quarter, 4 billion on the year.
4 billion on the year. Okay. So when I look at that, and I look at their kind of cash flow margins, and don't randomly hit my mute button for no reason, I then sort of get towards thinking, actually, I was thinking about this from it's still an 80 billion company, and then I sort of look at this kind of two ways. So I look at that as a price to sales, 80 billion on 4, it's 82 on 4 and a bit or so, and that looks like quite a high price to sales number, if I'm entirely honest with you, of sort of 20 or so. I get it's an AR, even on the ARR figures, it looks fairly big to my mind anyway. And then I sort of look at it in free cash flow terms, and we haven't got a PE ratio, and you gave some stuff about non-GAAP net income looking forward. Never mind that for a moment. If we talk free cash flow, and you said projected margins around 34%, which is close to where they are. They're a bit lower than that at the moment, so they're going to go higher on this. You get to sort of free cash flow yields of 1.5 maybe billion, and 1.5 on 82 is 1.8. That's growing. I mean, that's not massive high, but it's not crazy for a growth stock. So I've seen, growth stocks with lower starting yields than that, and Crowdstrike is a strong business that's obviously it had a big blunder, and there's a lot of scope for things to go wrong. But what you saw from the stock, if you're worried about that, and it is quite consequential when things go wrong for a company of this size and of this importance, is that it did recover pretty fast. I mean, I thought people were bidding this up perhaps a bit too quickly without working out properly what the fallout of this was going to be. Maybe I was right. And this will still work its way through a little bit in the financials and stuff. But aside from recently where it's been falling, and that's more a general market fall than I think disappointment about the earnings, although there's perhaps a bit of that in there. It's now roughly back where it was before its kind of July, I think, last year drop, which has put it in, I guess, interesting territory. I could see myself getting there. It's hard in a falling market where everything I own is in the red at the moment, and I mostly want to just buy more of that is the main reason. But Crowdstrike at today's prices, I could see someone. It's one is if I already owned it and was down on it, I think I'd probably be quite happy buying it again here.
When Crowdstrike originally fell down, it fell from about 370 down to about 217, and then without really much happening, the market bid it all the way up to 400 and sort of 50ish, and now the financials haven't really changed in terms of what's happening at the business. This was always going to happen. I sent it back down to sort of 330ish. So it seems really, really strange. Like the company, in terms of its actual margins, they're no different from when we sent it down to 217, 218, wherever it finished. And today we're at 333, and the margin situation has come to fruition. So it seems strange that the market is chucking this one down like this. It's a kind of like, it seems a bit like a baby in the bathwater kind of situation. But unlike you, Steve, I just think at 82 billion, I just think there's probably better opportunities elsewhere. It's still, after those two big falls, still a five bagger over the last 5 years. Been an incredible performer. But I just think perhaps for me, I'd be looking elsewhere, Steve.
Yeah, to your point about this sort of seemingly inevitable, I mean, to my mind, the real fallout from this was always going to be one of two things, either some sort of fines or people leaving. And actually, retention is very, very strong, it looks like, at Crowdstrike. And that's the thing I'd really be looking at. Admittedly, I'd be looking at it in the more likely previous couple of quarter results here. But the end of year results are still showing pretty good retention, and that either shows you that people don't want to leave or can't leave, despite a colossal blunder back in July. So my general sense is that this is actually probably as good as you could have hoped for if you're an investor. That's not to say, as an investor, you necessarily had to be buying it when it was a bit higher before and up around the sort of 100 billion mark. But if I were having a kind of businessy view of this, I'd say that's probably about on track for where I'd be hoping for at the moment. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.